The markets to individual companies, Mastek in focus. They're not subscribing to Majesco US's rights issue. They plan to demerge Majesco. That's the big question. And whether or not their revenue growth is going to sustain at 15 to 20%. Chatting with us today, Abhishek Singh, CFO at Mastek, joins us in the show right now. Abhishek, hi, morning. We've understood that you have not subscribed to the rights issue by Majesco. How do you plan to use the company resources?
Thanks for having you on me on your show. Majesco was demerged from Mastek way back in 2015, and since then both the organizations have been charting their own course, investing resources for the growth and development of the respective companies. Our holding in Majesco has always been of financial nature post demerger, so not subscribing to the rights issue was a logical decision, given the fact that we have got significant opportunities to invest within our business, especially in the digital commerce and enterprise digital transformation story that we have been working on both in UK and in US.
The markets are perceiving this a prime objective for demerger. Is there a demerger in the pipelines for the company?
Actually, the demerger happened in 2015. May of 2015, we demerged and Majesco was separated from Mastek. So I don't see that there's another demerger that's needed. Possibly the term that people are looking for is monetization of our holding in Majesco US, and that's been one of our stated objectives for last as many quarters that we have said it, that asset is out for monetizing at an appropriate valuation to be used for Mastek's growth.
Right. Currently, the revenue growth in UK is 20%. What are the growth drivers and how do you plan to sustain this growth momentum?
So the growth rate in UK is higher than that. It's closer to 30%, and it's predominantly driven by the fact that the way UK government space and retail space is buying from niche service providers like us, who are driving the enterprise digital agenda that they have both for government as well as for the private sector. And the demand is fairly robust, is reflected in the pipeline in the 12-month order book as well as the multi-year order book that we have, and then we measure it as all the lead indicators. I think the post-Brexit scenario would also present some interesting opportunities, given the fact that the departments in UK need to be created to run the show post separation from the continental Europe. And we believe that there would be IT demand that would be coming across that needs to be serviced. The good part is that there won't be any incumbents, and it would be about the best man win the business. So the demand, in other words, we see good demand, good traction, and expect it to continue forward.
Okay. So what are the margins that you're earning from the US currently, and what are your expectations for the second half, if you could briefly highlight that?
Sure. US has been the favorite question all around, and just to put it in perspective, while we in UK have been there for almost 27, 28 years, give or take, in US we have not been there for as many months. So US is clearly in an investment phase as we talk about it. And again, it was the driver for that was the demerger. Post-demerger, Mastek had no business presence in US, and we started with an inorganic initiative in the digital commerce space. And ever since that acquisition, we have defined the value chain and we have been investing in that both in terms of leadership as well as capability. And as we talk about it, I would say that the margin profile for that business in that geography reflects the investment that we have continuously made. And it is a 12 to 24 month journey where those investments should reflect in the bottom line.
Okay. So with the current competition in US, what is your strategy really to expand your business in that region?
I think US for us presents significant opportunity the way you look at it. Over last 12 to 24 months, if you look at the retail space, every major name is experiencing the kind of what I call as Amazon effect challenge. You got to move your business model from brick and mortar revenue per square feet, revenue per store model onto the retail commerce model out of internet, to put it simplistically. And this is where we come into play. We help the companies transition from their current brick and mortar model onto a significant web-based model. So while the larger sector has been reported as soft for the traditional services provider, for digital transformation company like ours, service providers who take the company on that journey, it is significant opportunity. And we are a niche service provider in that sense. So for the space that we are servicing, it is significant opportunity.
Okay, is the company looking at inorganic growth prospects in the near future?
Well, absolutely. It goes on, I would say, every day of the week. We are continuously corralling the market for the right kind of asset. Necessarily shoring up our capability in the digital commerce space. We had outlined it earlier as well that what we have right now is commerce implementation capability with be it Oracle, be it Salesforce, Demandware as an example. And we're looking at bringing adjacent capabilities would be in user interface, user experience or CPQ space, so to speak, that would make us full service provider, full spectrum service provider for the retailers going through their digital transformation. So the long answer to that short question is absolutely yes, we are out there looking for the assets.
Okay, thanks very much for joining us and giving us those details. Thanks very much for sharing your plans with us.
Thank you for having me. Cheers.